of green finance around the world. Thank you for joining us for this exciting session. We're calling this the big moves in transitioning the financial system. We're going to be looking at what regulators are doing, what fund managers are doing, what development banks are doing, what the emerging market implications are. A couple of housekeeping issues. There are 5 languages available. Choose the translation in your window if you want it. Question and answers are through the app that we have available. We will see if we can pick up a couple in the session, but mainly we'll be trying to answer with our Climate Bonds team as you ask questions. Everything's recorded. If you miss something or someone phones you in the middle of it to do a green deal, which we want you to do, take the break because you can get the recording afterwards. And tweet, note that the tweet is CBI 20. So hashtag CBI Conference 20. Thanks to all our sponsors for supporting this particular project. We couldn't do it without you. We have 4 participants in this particular session. First, Frank Elderson. Frank and I have managed to become good friends in our work in the high-level expert group in sustainable finance, which I think you'd agree, Frank, has turned out to be quite a seminal piece of work in how we take this whole agenda forward in Europe. He is the chair of the Dutch Central Bank, the Netherlands Central Bank, and also the chair, the newly re-elected chair, I think it is, of the Network for Greening the Financial System. I have an announcement to make. This might not be a surprise to you, I'm not sure. We've given our Green Pioneer Award to regulators to the Network for the Greening the Financial System this year. Every year at Climate Bonds, we have an awards program for pioneers of green and climate finance. This year, it's the incredible work being done by the Network for Greening the Financial System, an association of 66, I'll be corrected in a minute perhaps, central banks and supervisors around the world, working to understand what the challenges are in the context of climate and environmental challenges and what the appropriate response is on the part of regulators and central banks. I want to point you to one particular report issued 2 months ago on scenario planning. This is a seminal piece of work going forward. And I'll ask Frank about it in a minute. But we also have my good friend Satoshi Ikeda, who's the Chief Sustainable Finance Officer of the Japan Financial Services Agency, and has recently also taken over supervision of the insurance sector. I have a suspicion we're going to see a lot more conversation in the insurance sector about sustainability, but I guess he'll tell us in a minute. We have Rick Lacaille, who's the Global Chief Investment Officer of State Street Global Advisory Services, which is the 2nd largest fund manager on the planet. I mean, Rick, you have one extraordinary job. So I'm very keen to hear your insights going forward. And then we have Denise Odaro, again, a good friend. We've shared so many panels in the last few years. She's the head of investor relations at the IFC, but she also has a role of chair of the executive committee of the Green and Social Bond Principles. At Climate Bonds Initiative, we've been admiring, supportive, keen to collaborate with the Green and Social Bond Principles, and we are part of many committees. We work together very closely. It's been an incredibly important initiative to drive standards around reporting and transparency globally in what has now become a $1 trillion green bond market and a higher than $1 trillion when you include the daughters of the green bond market, the sustainability bond market, the social bond market, the green loan market, and now we're beginning to see recovery and resilience bonds. And what we're going to see next is transition bonds. Hey, that's a bigger conversation. Thank you, everyone. Now, let's get into this, if I may. Frank, we've been on so many panels together over time. You've been doing a lot of thinking about how this goes forward, and your members have been. I remember at the H-League, the high-level expert group, a conversation, and you were talking about, you said something to me, which I have to say blew me away because I thought, so obvious, yes, which is that the nature of the risks we face and the nature of what's happening in the world means that the past is no longer a good guide for what we have to do in the future as central banks. So we need to be moving towards scenario planning, looking at what the possible paths forward are. You've now done this and you put out a report. Tell us about this journey.
Well, thank you so much, and thank you for having me on this panel, and thank you also very much for the award. I know that you don't want me to give a Oscar award-winning an acceptance speech, so I will not. And before answering your question, I just want to remind all of you in the audience that today there was a report of the WWF, which says that global populations of mammals, birds, fish, amphibians, reptiles plunged 68% since 1970, actually the year that I was born. And if you don't think these numbers are terrifying, you will be terrified if you understand how that will translate in the end into financial risk for the financial sector, if that is what moves you, and not just as a human being looking at that waste that we are laying to the place where we live. One other image I want to start with as well. This morning I saw coverage of some people being interviewed on the streets of San Francisco, and it was during the day. But it was dark. It was as dark as if it was night because of the smoke. And it was not my words, but it was their words of the people in the street. They said, "This looks like doomsday." And but I don't also know, and that is something that Sean, you've always taught me, and I think very strongly along these lines as well. We have a moral obligation not to be pessimistic. But I always start out by giving just the news of today. And every day we see numbers like this, so that we are all we are convinced that we need to go forward. So what is the NGFS? The NGFS network for the green of the green of the financial system. 2.5 years ago we started with 8. Now you were almost right. It's now actually 69 members around the world. 69 central banks and supervisors, and growing. There's more in the pipeline actually for the rest of this year. 13 observers with the likes of the IMF, the BIS, the OECD, World Bank, and others. And actually, I thought you were going to refer to that. I think this is a tremendous leverage organization, and leverage is, of course, a term that we all that are active in the financial sector understand. As you know, we have tremendous leverage on the financial sector that we supervise, that we engage in with as central banks. Actually, as we speak, 3/4 of the systemically relevant banks, 2/3 of the big insurance undertakings in the world are within the remit of the central banks and supervisors that are presently member of the NGFS. So there is tremendous leverage on the financial sector, and of course, in and of itself, the financial sector has tremendous leverage on all their clients and therefore on the real economy. So if you talk about there being an extreme urgency to act, and then the obligation on everyone who has a job to do, then I think that over the last, 2.5, maybe 3-4 years, central banks have stepped up to that obligation and have gathered together. Now, it's one thing to form a network, but of course, that is just one first step, and then the question is, what do you do? So we have indeed brought out a number of reports. Maybe the most radical one was the first one, in which we actually made clear why climate-related risks are a source of financial risks. And of course, for those who have been thinking about this for much longer, it is a very obvious and a very open door kind of statement. But it was crucial for all those skeptical, and there are many, or there were many, within the financial sector and within the central banking community, to understand why this is within our mandate. So indeed, now we understand the mechanism how financial risks are being caused by climate-related changes in terms both of physical risk channel and the transition risk channel. By the way, what I also now in the last 2 to 3 years always point out on any occasion that I speak is that now we understand that mechanism. Climate change, physical risks, transition risk, if you like, reputational risk, translate our drivers into financial risk. That mechanism is a very strong explanation also in a wider range of SDGs, not just climate change. Also, biodiversity loss. That's actually why I started off with that example I gave with the WWF. And actually, the Dutch Central Bank has published a report, Indebted to Nature, in which we make abundantly clear with numbers the exposures that the Dutch financial sector has because of biodiversity loss via the same channels that I just pointed out in terms of the climate change. And that brings me back to the NGFS, as the mandate of the NGFS is slightly broader. It's actually also broader, just like your conference these days. It's not just climate, it's broader than that. We also look at environmental related risks using these same insights, feeding in the various reports of the members as the Indebted to Nature report I just referred to. Now, coming to your question, and maybe then giving the floor back to you, because you gave me, I think, 6 to 7 minutes. Yes, indeed. If climate change and the effects of climate change on the financial sector were to be linear and were to be easy to be understood, but just looking at the data of yesterday, this would not be intellectually a very difficult job to do, but it is not. There are cliff effects, there are all kinds of unknowns in the future, and actually what we have done is use knowledge and techniques that we have already developed in other spheres in terms of scenarios and in terms of stress testing to kind of like get a handle of what the future might look like, and then what the risks of that future might look like, and then of course what the reaction function of the central banks and supervisors should be looking at these various risks. Now the thing is that there is, academics all around the world have done a lot of work on that. But the difficult thing is how you incorporate all these things at the same time. So not just physical risks, not just transition risk, but all these things at the same time in one big model. And that is work that's being done. We also work with various fora of academics, if you like, around the world to bring that work further. But we did bring out very stylized, if you like, scenarios that are there to be used, are there to be built upon, in order to help central banks and supervisors, but also financial institutions around the world and everyone who wants to work with those, to bring this issue further. Maybe that by way of an introduction. And let's never forget, we cannot be complacent. There is an extreme urgency. We have learned from the COVID crisis, maybe that is the last thought I want to give it to you, that the world can change very quickly if we see a clear and present danger. So a part of this whole story is that we have to convince people that there is such a thing as a clear and present danger. And then I think we can master the amount of energy we need to change, but central banks and supervisors are there to play their role.
That's a critical issue, isn't it? About how we actually alert people to the nature of the danger. But of course, we're still constrained about what we can do with our institutional settings and so on. So before I come back to you, Frank, but you've raised so many things there that we want to pick up. I actually want to switch to Satoshi, because Satoshi, you're looking at exactly what can be done within the constraint of a national economy and a national financial system, and what's appropriate in the settings you have. Can you tell us a little bit about, well, for a start, the work you're doing in NGFS and how that links back to what you're doing in Japan, and what are the next steps for you? That's good.
Okay, thank you, Frank, for the question. Also, I'll thank you, Sean, for the question, and thank you, Frank, for your presentation. And well, I'm very proud that Japan FSA has been an early member of the NGFS, although it's not an original member though. But well, the scenario planning tools has been mentioned several times so far, and well, we are very proud that Japan FSA has been actively involved with developing that tool through, well, actually we have one staff member based in London working together with the PRA to develop that scenario planning tool. And that tool is a very significant milestone, not only for the financial supervisors community, but for wider communities, because it provides supervisors and financial institutions with effective communication tools in engaging with relevant stakeholders to incentivize them to transition to the net zero economy, and at the same time, adapting to the evolving new climate reality. Why is that important? Well, the climate change challenge cannot be addressed by the financial sector only. And looking back, in response to the global financial crisis, more than 10 years ago, financial supervisors forcefully required financial institutions to build up capital. And at the time, capital was king, capital was the solution. But in the case of climate risks, capital is only a part of the solution because climate risk is potentially so huge, so it is not economically feasible to prepare everything by building up capital. So in that sense, in addressing climate-related risk, capital is not king. So what is fundamental is to prevent such extreme risk events from materializing and incurring damage to the economic system and the social system. So in other words, protecting the financial system requires transforming the economic and social system in the way consistent with the Paris climate goals. So very fortunately, that actually serves the self-interest of the financial institutions. So for protecting themselves, they must act in that way. But well, sometimes financial institutions are too short-sighted and act in a very peculiar way. So financial supervisors' role is to ensure that financial institutions will protect themselves properly and in a timely manner. And that is why, well, Japan FSA has been engaged with the business sector in Japan, as well as the financial sector, and help them establish a platform for dialogues on climate-related risks and opportunities, which is called TCFD Consortium Japan. And this is why Japan FSA is partnering with the 2-degree investing initiative for assessing transition risk in the Japanese financial system and plans to conduct a scenario analysis based upon the NGFS scenario planning tool. And this is why Japan FSA is embarking on utilizing the database for policy decision making for future climate change. It's called D4PDF, which is developed by the government of Japan to assess physical impacts of climate change and enables us to look into detailed physical impacts within the 2 by 20 by 20 kilometers grid. And this is why Japan FSA joins the Climate Transition Finance Working Group of the ICMA and works closely with METI, Ministry of the Industry in Japan, to develop transition finance guidance. And all in all, it is creating a proper incentive system for transitioning to the net zero economy and adapting to the new climate normal, thereby protecting the financial system in the coming future. And so, well, doing so is the self-interest of the financial system, financial institutions, and well, that open the door for creating shared value for the society. And well, actually, that is a very basic and fundamental concept of the Japan FSA's sustainable finance policy. That's it.
A bit more about this shared value concept, and also, Satoshi, how do you think that works plays out in other markets? Do you see differences in approaches between, say, Europe and the US and Japan on that question? Because that's a very interesting concept. What does it mean first? Give us a bit of flavor.
Well, I think my sense is that, NGFS scenario planning tool certainly fill the gap of the necessity of such kind of tool, because TCFD encouraged the financial firms and business companies to conduct scenario analysis, but they are struggling because they have not been yet comparable tools for scenario planning. But I think the NGFS has provided a standard for comparability in scenario planning. So I think because there's such needs, I think NGFS scenario tools will be not only used by financial sector, financial firms, but I think it will be used by the business sector. in the end. So I think that will be a platform for scenario planning to assess climate risk in the future. So that is why I call it a significant milestone.
Frank, you've got one hat as the chair of the NGFS, and I think that the interesting thing about the NGFS work, from my perspective, and the Climate Bonds Institute from our perspective, is the extent to which regulators agreeing in a common voice about these forward risks is changing the whole intellectual framework of the financial sector. You know, it's a bit like the gods, and I'm sorry guys, but you are kind of gods for most people because you affect people's lives with some of your moves, are saying, right, this is happening, and everyone else is now saying, oh God, oh my goodness, we have to start taking it. This is what we see cascading down to the financial sector. But you have another role, which is the chair of the Netherlands Central Bank. I'm sorry, there's a long title, but let's think of that for the moment. And you've been working also domestically on this issue. Picking up Satoshi's question, how is this playing out domestically, and what does it mean in practice for what you've been doing in the response from the sector?
Right. Well, you give me too much honor. Actually, there is a president of the Dutch Central Bank. That's not me, but I am I'm a board member and I'm in charge of banking supervision. But yes, what we have done in the Netherlands is, I think now 4.5 years ago, we established a platform, which I also chair, and where we bring in actually, this is a very Dutch way to do things, to just bring in everyone, like in a big tent. So the industry, the association of the bankers, the insurers, the pension funds, but also various of the ministries of finance, of the economic affairs and climate, the market conduct supervisor, academics, us. So there's a big group of people that come together and share experience, have working groups on all kind of the issues, etc. You can imagine. That has helped a lot to do what you just referred to find also a common, not just way of looking at it, but also a common way of talking about it, a common vocabulary. So that is one thing. The other thing is, and actually, you know, when there's two ways why financial institutions act. They act because they think that we tell them it is necessary to do, and they do it because they think themselves inherently, coming from their DNA, if you like, that they think it is important. That is, of course, much better, because that means that they also continue to act like that if you don't look, and we don't always look because we have scarce resources. So the whole network idea is actually not to tell people to do things, but to convince people that they actually want to do them, which is a big difference. Now, sometimes we tell them to do things. And one example, because you asked about something very realistic, and you see the interplay between, you know, a supervisor coming in and then the free market doing wonderful things. When we looked, I think it's already 4 years ago, to the exposures to real estate, and there's legislation in the Netherlands that says that you have to have a certain label in terms of energy efficiency. And it needs to be a C label in 2023, an A label in 2030. Well, you know, schemes like this exist all over the world. So we asked the banks whether they knew their exposures to real estate and what labels these buildings actually had. Half of the banks had no clue, and half of the other banks knew about half of their exposures. So that was us coming in, looking from a risk side and saying, well, you better be sure that you know these labels, because if there is a label that is too low, you can rent out the edifice. Now, the wonderful thing was that the private sector actually turned that coin around and said, okay, well, if there's this risk, there must be opportunities. So banks going to their clients saying, you know, you have a dirty building, but I can work on that, and I can give you an extra loan, and we can make sure that you get to a better energy label. So I think this is one, but there are many other examples. But this is one example of us coming in, drawing attention to a risk, the institutions understanding, and then saying, okay, but if you want to manage that risk, we can actually also get a return on that. And then they going to their clients and actually making real changes in the real economy. So I think that is an example. I see you struggling.
A simple measure, though, right? A simple measure, which you could be doing
very simple
all over the place.
That's right.
Including in emerging markets. And so with your response from emerging markets, where central banks have often been a little bit more interventionist in the market because of history and so on, is this a conversation that's happening too? Is the response amongst the members to do something? Or you get it? Tell us about it.
Yeah, well, I would say that you know, first of all, we had to make sure that, you know, we would have a good mixture of central banks around the world, and not just, you know, European, the developed world centered membership. And I think from the very beginning we managed to do that. So even these first 8 were from you know, from Asia, from the Americas, from Europe, from Africa, and now I must say I think it is a very good mix of Pacific Island states, of emerging economies, developed the economies and the like. And again, still growing, and we could even become more diverse. But I think that so there is insights from all over the place. If I look, for example, at the biodiversity issue, which I mentioned before, Costa Rica is very interested, and they want to play a role there, as well as China. So we see really people from all over the world, big and small, coming together around these issues. And then there's another thing. We don't all have to reinvent the same wheel. So the good thing is, it might have taken us at the Dutch Central Bank 9 years to get where we are now. But once you get, you know, you lay your hands on a report like what you were referring to, the scenario planning, or on the biodiversity loss, you read the report, you understand the mechanics behind it, you see the numbers, and you can actually, you know, it's there to be used. And I think increasingly that is what is being done.
Satoshi, to what extent does a scenario planning report, I know you're involved in doing it at the NGFS level, have to be adapted and tailored to differing local circumstances? I mean, how complicated is this process of applying that high-level scenario work that's been done? Because I know this is something you're looking at in Japan.
Yeah, you are right, because right now the scenario planning tools are made on a global basis. So it needs to be tailored to the local circumstances. But I think, well, first of all, before endeavoring to, well, you know, tailoring to the local circumstances, I think the simple way of using it is because on the global basis, this is going to be happen under a certain scenario. So let's check your resiliency to the climate change by using the global-based scenarios. And that is a very simple first step. But you're right, we plan to put into more data into the scenario database of the local data, Japanese data, Chinese data, Dutch data, and so on. And so that in the end, we can make a more granular analysis of the effect of the climate change on the financial system. But it is a long journey, actually. So, very practical step is, let's come to terms with the fact that we have only that tool yet. So use that. So that is my message.
I mean, in Japan, the specific tools, for example, the one Frank mentioned around energy efficient loans, energy efficient buildings, these are the sort of things that METI would have probably done in the past rather than regulator, a slightly different kind of configuration of who does what in the system. Soft power, which let's face it is 80% of a central bank's power, the conversations you have in the corridors and so on, is a critical part of it. What can Japanese institutions expect going forward, do you think? What sort of signals can you give us today? Now, I appreciate you've got to be careful what you can say, but I know you've been thinking about this in terms of sustainable finance initiatives that they need to be picking up in terms of the banking sector and the insurance sector and across the financial sector.
Well, I think it is resonated with the theme of this seminar because METI and Japan FSA were collaborating to develop the transition finance guidance in Japan. I admire the work of the EU to develop the taxonomy. But I believe that we needed another initiative to finance transitioning to meet the needs of the very various shades of green. And transition finance, I believe, is make business firms to commit to a goal consistent with the Paris climate goal, and to monitor the development and make finance accordingly. And so that is suited for the high emitting sector to move towards the world of the Paris climate goal. And that is the very inclusive approach for transitioning the economy to the net zero economy. So, that is what we are planning to do to protect the financial system, actually, from the supervisor's perspective. But at the same time, that will encourage the financial institution and the business firm to create the shared value. That is the value for the society and the natural environment. But at the same time, they make money out of it. So that is the happy scenario.
Frank, you've got to jump off in a minute to another meeting.
Sure.
Final comments. I'm also interested in those final comments. Someone asked on the Q&A, are OECD central banks learning from emerging market central banks in this, given there's so much board membership? You know, PBOC, for example, in China has been very aggressive at green finance measures. But really, I'm asking for a farewell comment, really. Where is this going? You have this global coalition of 69 central banks and supervisors plus extras going forward. What are the next steps in terms of the interaction between them all and how the agenda goes forward?
Right. Well, I think that what we need to do, sorry for this. What we need to do is to make sure that as long as there are central banks that are not involved, we have an agenda in order to spread the word. That's one. Then we have to look at ourselves and look at all our different roles and tasks. It's not just supervision, it is also monetary policy, it is also reserve management. It is a very broad range of issues in which we act, and not every central bank is already doing this in its entirety. And I think that we should. So that is another part of this agenda. Then, you cannot have a green, sustainable financial sector in a world that is not. So to a certain extent, we have this wonderful inroad in how things are going in this world. We have this double leverage, as I explained in the beginning, but we need more. So we also need to raise our voices and talk to policymakers, not just those that we supervise, but also those that make the policies, and explain why it is so extremely important from our perspective that there is a Paris Agreement. So there is clear deadlines. So financial institutions can plan and can manage their risks knowing that. But we need a Paris Agreement also for biodiversity laws. We need more clarity on future policies so that the financial sector can manage those. And I think that the NGFS, of course, is not a political organization, but we can translate very easily the need for clear policies and deadlines so that within our mandate, we can make sure that we have a green and sustainable financial sector, which of course is key in the end to achieve these goals. We must keep talking about this. We must translate technical concepts to things that people can relate to, and people must, and I think there we also have a role to play. In many countries, including mine, the financial sector is not very popular. But we are not going to solve this problem without the financial sector playing its role. And I think it is a wonderful win-win situation for the world and for the financial sector if it is able to actually explain to people. And I think we as a regulatory community and supervisors and central banks can play a big role there to explain the vital role that the financial sector has to play.
That's a really important task going forward. And as you say, it is just finance. At the end of the day, it's the real economy that has to change. We're not going to solve biodiversity by shifting money around. We actually have to change our protection of nature and how we support and make our ecosystems sustainable. And we've got so much to do in this agenda. It's terrifying at the moment, isn't it? I had a message yesterday from a friend in California who's writing climate policy as the ashes gently fall outside her window. We're seeing climate impacts in real time, right in front of us, and biodiversity destruction is one of those climate impacts, because it's about how we manage the planet, it's the impact of climate, but of course it's also about just how we live on the planet in a common space with our other species. That's what we have to tackle. Frank, thank you so much for joining us today.
Thank you.
I really appreciate
it. It was
the time.
a pleasure.
We'll be working with you again in the future, but I know you've got to go. We'll now shift to Rick Lacaille.
Wonderful.
Over and out, and congratulations for your work.
Thank you. Thank you.
Rick, can I bring you in now? You have what can only be called one of those crazy, amazing jobs, trying to steer as CIO of State Street Global, which is a vast pool of capital you're managing on behalf of all your clients. What do you see? What State Street's response to the kind of agenda that Frank and Satoshi have been laying out for regulators, and of course the other things we've been talking about during the course of the transition conference? Where are you going as a fund manager?
Yeah, thanks very much. And very, very positive right from the top of our organization. Ron O'Hanley, who previously was CEO of SSGA, is now CEO of the whole of State Street, and has been very supportive of what we've been doing internally as an organization, but also externally as an investor and with our clients. So we're very positive about the agenda. One important point, though, is the capital that we manage, about $3 trillion, not our capital, it's clients' money. So we're at the, we have to provide what clients want, and we have to provide leadership to those clients in the way that we articulate our view of the world, encompassing climate change and other things. So when we think about our asset stewardship program, for example, where we're directly engaging with corporates about the risks that we see and how they might think about those risks, climate change is right up there in terms of our agenda. But if I step back from it, what are we doing as an asset manager? We're connecting what all of finance is doing, connecting people who need capital and those who have capital, and trying to do so as efficiently as possible. And in the green transition, it's a classic case where there's a lot of capital needed in order to render the change that we need to have. And then there's the supply of capital on the other side. I think that capital is moving. I think that when I think about what our clients want, they want long duration assets for the most part. They're very long-term investors. Increasingly, the wealthier nations' retirement systems are rolling into a period where they want very long duration assets and income streams that are reliable. And in many respects, that lines up very well with the capital needs of the green transition, because a lot of it's to do with infrastructure, energy, transmission, other things that need, in a sense, rebuilding or restarting, but which have very, very long-term cash flows. So I think there is a very appropriate marriage, if you like, between the supply of capital and the demand. And there's another dimension as well, which is you've got consumer or institutional appetite for using their capital in a way that's going to make a difference. Now, not everybody thinks like that. And I think for the most part, our clients are sort of unconditional investors. They want to have a suitable return, managing risks, but they're not particularly applying their values, so to speak, to their capital. But that's an increasing proportion of the asset management universe, those clients who want to express their values. And that's why we have, in a sense, a plethora of products being produced by the investment industry. And we have to be a little careful in the investment industry not to repeat the mistakes of the past. We need to produce things that are fit for purpose and suitable for clients, and make sure that there's no chance of mis-selling or anything else. But I do think in the green agenda, sustainability more generally, there's an increasing appetite, particularly in the wealth sector. And our role is to organize those products in a way that is fit for purpose, and we've done so with funds and ETFs in order that we can achieve that.
You're rolling out a series of new funds as we speak, and I know climate bonds. We've been working with your team on this. I don't really want to turn this into an advertisement, but I do want you to tell us what they are, because I want people to know about them. I want people to invest in them. Give us a flavor. Give me a bit, make it real.
Well, again, we can't necessarily talk about funds in a public forum where we've got people from
damn.
There's legal issues, but suffice it to say that the climate strategies that we have, both on equity and fixed income, are focused on maximizing capital going into green revenue and, in a sense, constraining brown revenue quite significantly, but also looking at physical risks and making sure that we're appropriately positioned from a physical risk perspective. Often where we will be looking for green bonds, we'll be looking for specific issues that are directing capital in the right direction. And that's part of our portfolio and part of our fund range, whether it's on the ETF side or on the fund side. They're not everywhere in the world equally. That's why it's a little difficult to kind of characterize it in one soundbite. But they are a really important vehicle because investors are facing negative interest rates. If you look in Europe or many other countries in the world, negative interest rates out to 10 years. So there's a real thirst for spread, and spread is delivered to a large extent by these types of bonds. Sometimes they trade through government bonds, but very often they're able to deliver spread. So we're very enthusiastic about that.
We've had a lot of questions about emerging market appetite, speaking of spread, compared to, say, Germany. What does that mean in terms of what you're telling to the market, your appetite for emerging market issuances in the green and sustainable and, of course, now transition space?
Yeah. Well, first off, I think the basket of emerging market local currency bonds is an investment we favour. We think that that'll pay off well for investors, both in the short term and the long term. And we know that it's attractive because it's got quite high yields. We also know from research we've done in ESG that we really should be thinking about tilting that portfolio away from those countries that are more vulnerable or haven't exhibited the right sort of policies from an ESG perspective towards those that are more stable and, in a sense, are a more reliable return for investors. We haven't launched a product, so to speak, on that, but our research is showing that, and that's, in a sense, the direction of motion that we're taking. I think in addition to spread assets, so once you've gone into emerging market local government bonds, the attraction of having a little bit more credit premium and spread is significant. And when I think about the transition, the amount of capital required in emerging markets is absolutely enormous. The capital is needed there at least as much as it is in developed economies. And I think if you ask me where our clients will be invested in 20 or 30 years' time, I think they'll be much more heavily invested in fixed income and in emerging markets, and an emerging market fixed income that is supported by those cash flows from transition assets.
I want to get Denise's view on that in a minute, but I just want to finish up on this question. Foreign currency exposure. We had a little conversation about this the other day. One of the challenges for emerging market issuance in the green space has, of course, been a world dominated by hard currency appetite. But you were suggesting this is changing a bit, that there's greater appetite for local currency denomination. Tell us about that.
Yeah, well, I think the dollar bonds, government dollar-denominated bonds, are becoming less liquid. There's a constrained set. And I think post-1998, many emerging markets began to develop their own capital markets. And I think that's a very healthy development. They are very freely determined yields. They're not necessarily squeezed by some of the central banks, and therefore the returns might be better for investors as well. But I think that's one of the most healthy developments in capital markets in the last 15 years, the development of local currency, long duration fixed income markets across a whole swathe of countries. It really helps to stabilize those economies. And in many cases, the mistakes of the past won't be repeated in the future. So we're great enthusiasts for local currency. I mean, dollar bonds have their place for sure. And there are clients who really can't stray too far away from home from a currency perspective, and they serve a purpose.
You mentioned duration. And of course, long tenor has been, again, a very big challenge in emerging markets. But you've talked recently about the increasing appetite for long duration products, which of course is music to the ears of people building long-term assets like wind farms and renewable farms. I mean, is this just a ripple at the moment, or is this really a substantial issue? Again, also looking at emerging markets.
It's a very substantial issue. Obviously, as investors, you need to be discriminating. If you look behind me, it's a painting by Gustav Klimt. It was painted in 1912 in Austria, and shortly after they had the catastrophe and then hyperinflation. In fact, recently Austria launched a 100-year bond. So again, that will pay off in 100 years' time. And you have to ask yourself, what does the world look like in 100 years? There's a lot of uncertainty out there. But the cash flow from many of these transition assets is what should give people a degree of confidence about those long duration assets. And there's no doubt with rising longevity in many of the countries, the demand for long duration assets will be very, very persistent. And it happens just as people's pension assets, just as people are getting into that sort of late 50s, 60s, that's when they start shifting into these assets. And that's when the pool of capital is at its highest.
So you've heard a lot, folks, about investor appetite from Rick's perspective. Denise, can you tell us about your appreciation or what you're seeing in emerging markets first, and then, of course, how you're responding at IFC to this agenda?
Absolutely. First of all, thank you very much for having me. It's been utterly delightful to hear all the speakers prior to myself. I think going from Frank to Ikeda-san and to Rick, it's been, I would say, notes that have formed a melodic chorus to my ears. I mean, so starting off, for those who don't know IFC well, we're a member of the World Bank Group. Our focus is the private sector. So we make loans and equity investments in the private sector. And I think just starting off with touching on the notes, in fact, that Rick had mentioned. So when you look at the risk side of things, right, the 21 emerging market economies that contribute 48% of global emissions. So taking that risk and coupling that with, as Rick had also mentioned, what the opportunity is. So this is an IFC analysis that we did recently that shows that there is around $29 trillion worth of climate business opportunities in emerging markets between now and 2030. And that cuts across sectors, from public infrastructure to green buildings, etc. So to my mind, what this means is, should the right conditions exist, this should be a natural appeal to the private sector. And this is where DFIs such as ourselves come in. So IFC, we're at the nexus here of the play in emerging markets, climate strategy being a key priority for us, and drawing on what Ikeda-san said about shared value, which I actually wrote and underlined, because I think this is where we as a society need to focus on. We really need to rethink our value system. Looking at the value system, you hear the frightening stats that are in this WWF report that Frank mentioned. And you think, how did we get here? The system we have, there's the natural environment that we came out of, if you believe in science, right? Which hopefully everyone who's watching this does. And out of that, we created the economy. And unfortunately, it's this perverse life that we live now, that the economy dictates everything that we do. And, we're at the point where we ought to seriously look at the system. And I think that the fact that we're having these conversations within the financial sector shows that that is the case. So shared value and that idea that recent topical events, such as obviously the pandemic that we're going through, the racial and social issues that we're having, are basically shedding again a spotlight on the fact that we ought to pay attention to the risks that we have not all along. As I said, coming back to answer your question, so IFC is sitting at that nexus where you have the shared value, emerging market, the private sector, and of course, climate being a strategic priority. Now, how are we addressing this? In various ways, I would say primarily, the first thing I would mention is our bond program. So on the green bond side, as you know, and thank you to CBI for giving us the award a few years ago for our landmark transaction in 2013, which essentially is the precedent for the market that we see today, $170 billion in 1 year, when in 2013, IFC's issuance was in fact 25% of the global issuance, including the 2 benchmarks that we did at the time. And so to date, we have done over $10 billion in 16 currencies. And of those 16 currencies, we've done a number of emerging market currencies as the first issuer in that country, and also green. In addition to that, IFC acts as an investor. Over the last 2 years alone, we've assisted 9 clients in issuing green bonds to the value of about $1 billion. And again, just in case it wasn't obvious, these are all in emerging markets. And most of those clients, in fact, these were the green bonds that we assisted them with were the debut issuances. And the third thing we do, one of the things that we offer is an online tool which helps financial institutions assess climate risk. And this is called CAFI, and I urge you all to have a look at it. So the climate assessment financial tool that we have. We've had over 110 clients use the system, and loans to the value of around, I think it's around $43 billion that they've actually gone through this system. Now, adding to that, we act as a key mobilizer, and the 2 funds that I would like to mention, which I think a lot of people already know about, of course, is primarily the emerging one, the Emerging Green Fund, which is our EGO fund, which remains the largest green bond fund in the world focused on the emerging markets, a $2 billion fund. And as of June of this year, that fund already holds 25 financial institution issued bonds in emerging markets. In addition to the fund, I want to underline that this fund comes with a technical assistance program, which is really key in the emerging markets when you think about the need for capacity building in some of these really nascent economies. And so this is a program that is very active and has put out there a couple of trainings and bringing in financial institutions and enabling them to eventually issue transactions, which they have done, and the fund has actually bought a couple of those. Most recently, we've closed another fund, which is the Regio Fund, a JV with HSBC. It's the 500 million fund that was closed in June. And that fund is a real economy fund. So we have now gone beyond the financial institutions, looking at the real economy. Again, that fund also comes with a technical assistance program, similar to the EGO fund, which is financial institutions only. The underlying, I'd say the last point I mentioned is the work we do with regulators, which obviously ties into what was mentioned by both Ikeda-san and Frank. So we support regulators, and we have done over 10 national and regional green bond guidelines that we've assisted with. And as you know, Sean, because you've been involved in the Sustainable Banking Network, IFC acts as a secretariat to that. So you have 39 countries as members of the SBN. And there's a working group on green bonds there. So across the value chain, IFC plays a role everywhere, and we're a unique one-stop shop.
You've played this role of market development and in many of these countries. And as Rick was saying, it's been fantastic to see the development of capital markets in many of these countries. What people don't often realize is that the extent to which IFC has supported that, working with local banks. You've also played a role in picking up risk, first by kickstarting, getting some issuance, and then risk guarantee facilities. And of course, that's what the EGO fund is in its own right, a blended finance risk tool. I guess I'm interested in exploring this issue of risk with both Rick and Satoshi. When we're seeing funding going to emerging markets, and we will come back to developed markets in a minute, there is a sort of question about the relevant risk appetite point. You know, we now see, I think, Rick, fairly clear appetite for sovereign level or high rated issuance in local currency in domestic markets. How far down does that risk appetite go, particularly in local currency in general? And I guess I'm sort of asking really, how much more does the IFC need to step in to make that bridge work to get the capital flow in the green space? What's your perception? And then Satoshi, I've got a question to you I'd like to think about, which is in the Japanese circumstance where we've seen Japanese funds get a bit of yield by going overseas and taking risks to balance out their huge domestic holdings. Is this going to grow? And can we see some more increase in exposure to the ASEAN market in particular from Japanese investors? Is that an issue for you as a regulator? Do you see that as plus or minus? Rick, over to you.
Yeah, well, firstly, I think the IFC does do a fantastic job across the kind of capital spectrum. And I wouldn't want to suggest there's a kind of huge gap. If there is a gap, or if I look at it from our clients' perspective, you know, knowing our client base, they're unlikely to invest at the very earliest stage from an equity perspective, more like a venture capital construction risk or political legal risk very early on. But they're completely comfortable with kind of operational economic risks, both in fixed income and equity at a more mature stage. So I think that there may be a gap that I see, but it is, I think, pretty effectively filled by many other actors. But I've heard that from other policymakers, that if there's a gap, it's at the very earliest stages of capital provision. And I think you don't get that from banks because the capital treatment's not very favorable. Therefore, it's from people who are in the industry themselves or multilateral institutions. And again, to give IFC their credit, I think they understand and I think have been very active in that area. Whether there's a way of supercharging that supply of capital is, I think, a really good question. I'm not sure we're the right institution to answer that question, though.
Which perhaps takes us to Satoshi, because Japan is one of the engines of the world economy and one of the engines of investment in the Asian region in particular, but globally. So, Satoshi, you're not a fund manager, you're working in the regulator side. I guess my question is, are there any issues in terms of risk? And in fact, would you be expecting greater investment overseas in green as part of the overall thinking about sustainable finance in Japan in the future? Which of course then might give IFC and others more opportunity to be pitching green products in Japan. What do you think, what do you feel comfortable telling us?
Right. Well, first of all, I would like to say that, well, developing the local currency market in, well, Asian region has been the priority of the Japanese government since the Asian financial crisis in late 90s. And the government of Japan has been, well, assisting the development of such markets in each country in the region, so that they can, manage the, currency risks associated with dollar-dominated capital issuance. So, that is, in a sense, the very much come to the heart of the the government of Japan's mind. And at the same time, though, obviously the emerging markets currency fluctuates very much. So managing that risk is very crucial for the financial institutions. But at the same time, I'd like to point out that because the Japanese financial institutions are increasing their presence in the region through the local subsidiaries and the other channels. So actually, in terms of their deposit to lending ratio, there's a huge gap in terms of their risk profiles, because there are too little local currency funding, but in the balance sheet, in the asset side, there's so many assets denominated in the local currency. So in terms of the managing that currency mismatch risks, I think there's a certain opportunity for expanding the investment in local currency denominated bonds. And also, but currency risks is sometimes becoming too volatile. So to manage that risk, to assist manage that risk, the Japanese government also, or actually just the Bank of Japan, have a certain agreement with the local central bank to provide a certain lending facility to local subsidiary of the Japanese bank. And that provides a certain opportunity for exit from the investment in local denominated bonds. And so if that backstop is in place, Japanese financial institutions are more inclined to invest in local denominated bonds. So I think we're working on that framework has a certain hope for expanding the local currency bond market in the Asian region.
They're very optimistic words, Satoshi. Thank you. I guess, Rick, SSGA is a significant player in the Japanese market representing asset owners in Japan. I know, for example, that your work of GPIF has substantially increased their interest in green bonds over the last year since Hiro Mizuno, who spoke on our first day, became CIO there. Are you seeing this happening already, as Satoshi is saying, this change, the increase in demand out of the Japanese market?
There's increasing demand out of the Japanese market. Maybe there's a little bit of a parallel with the Netherlands and some of the Northern Europe, in the sense that there's a growing recognition at the political level, and through that business and consumers as well, of the risks that are being run, not just climate change, but other ESG risks. And I think GPIF articulated very clearly how they thought about that as a very long-term investor. And so that's reflecting itself in changes in behavior of other pension funds, but also in the wider community of investors. And so when we're trying to design products for whether the wealth management market or elsewhere, these are really, for us, very important considerations. But I wouldn't say it's a rush of capital. It's not a kind of focused rush of capital, but I think that's characterized as, in a way, financial markets everywhere. You get a little bit of capital coming from a lot of different places, and in the end, it's directed in a way that makes quite a big difference. And I think you also get to this sort of point where you get liftoff. You know, you get a little bit of chat, and then it spreads more widely. It's like Hagerstrand's diffusion of agricultural innovation. You know, eventually you get this sort of spreading, and it becomes significant. So I do think Japan is a similar case to Netherlands and Northern Europe in the sense that it's awareness and interest.
Now we have to ask you because you're a US-based fund manager, what's happening of appetite in the US market in all of these things? Is there a parallel of what's happening in Europe and of course now in Japan?
There's a parallel in some quarters. I mean, listen, it's no secret there are disagreements, particularly in the US, and the disagreements tend to run more along political lines than they do perhaps in other countries. But suffice to say, there are a large number of very large scale investors like public funds who are interested in, you know, anticipating risk and taking action with their capital. I think the private sector, I would say the interest is focused more in the wealth management market. So wealthy private individuals in the US who are, again, interested in using their capital and really averting risks with their capital. I'd say that in the corporate space, it's very mixed. You've got a lot of interest amongst some, but it's by no means universal.
I mean, you've seen some big issuance out of the US recently, Silicon Valley, of course, with the Alphabet deal in this particular space, and Apple before it. So, and I believe they got a very positive response from the market. So there's clearly something bubbling on in some quarters, as you say.
And I think it's a really good reason why we should never generalize. I mean, it's always a good thing from a diversity perspective, never generalize. So we talk about America, it's a very complex nation with individual actors and institutions. And I think they're not pulling in different directions, but they're certainly pretty diverse in the response. I think it's unfortunate we've got a little bit of a schism, if you like, between US and Europe, you could say, in sense of what sort of action we're taking at the policy level, but that is not the whole picture. I think, as you point out, you've got a lot of corporate activity on the ground.
And I think this point you mentioned about different schisms in policy level, one of the things that we heard from the Principles for Responsible Investment CEO, Fiona Reynolds, and also from Hiro Mizuno actually on the first day, is the extent to which major investors, major asset owners, I should say, seem to be calculating in forthcoming policy change and policy risk as something that is set. It's a matter of when, not if, and rethinking their portfolio allocations or forward plannings accordingly. It was an interesting perspective. I mean, does that sound right to you? Do you think that's correct?
It does sound right. I mean, I think you always run the risk as an investor of looking too speculative when you're anticipating policy actions. There's a kind of thin line between that and speculating in a way that may not be substantiated by the facts. But the facts are changing, and we know that popular support for action is growing. And I think when you ask companies TCFD questions, or as you say, as we ask in our engagement program, companies about how they think about these risks, they are baking in a degree of policy action. Now, they may be baking in other things as well, like they may be baking in the fact that the climate may change beyond the 1.5 or 2 degrees that many might aspire to, and therefore planning their business accordingly. But I doubt whether anyone's planning zero policy response.
A question to you, which I know will be very important to Denise at IFC, which is you've talked about starting to look at sovereign issuance. You know, we've seen some strong thematic issuance recently, some fantastic, as far as I'm concerned, issuance by the Swedish government, the German government, and of course, and the Thai government just in recent weeks in the thematic space. But you've talked about how we need to be moving towards understanding sovereigns as a whole, which is a bit like the conversation I had with Jin LeCun and Yves Perrier yesterday around assessing entities in the corporate space to understand what their transition and trajectory plans are and what that means for forward risk and possible proactive investment. How far away do you think that is in terms of at SSGA and your methodologies and approaches to be able to get a better granularity and understanding of that?
Well, it may not be the first order issue, but it's coming a close second in the second order issue. And again, it relates to actually a lot of the UN SDGs. If you think what is going to be able to promote better long-term growth and stability, which affects ability and willingness to repay debt without debasing the currency, you know, gender equality, health, all of those things matter in terms of building up human capital and eliminating some of the obstacles of growth. But climate change looms very large because in many cases they're commodity-related countries, and in other cases they're vulnerable, very vulnerable to changes in climate. So they are going up the pecking order in terms of what's important for long-term investors like us. But it's not to dismiss the kind of, in a sense, orthodox and sort of boring things about economic development, policy developments, and political developments within each individual country, which are important as well, and maybe not independent of climate risk management, but they are important in their own right.
And I guess we've now got the issue of the quality of recovery measures in building the sustainability of those recoveries going forward on the agenda. We'll be talking about that in a session in a little while this afternoon. I mean, Denise, this is, and I appreciate, Rick, you've got to jump off in a minute, but let me just ask Denise a question, then ask a final word from you. Denise, this question about the assessment of debt from countries in emerging markets is vexed, isn't it? Because we have countries that are making strong steps on sustainability in the area, but equally we've got countries that are more exposed to climate impacts than, let's say, the Swedens or the Norways or the UKs of the world as well, and therefore their risk levels are going to go up. I mean, what do you think? What's IFC looking at doing? What can we do to address this?
You know, I'd say it's a conundrum, quite so, in that, as you mentioned, a number of emerging market economies, if you look at Africa, for example, very, commodity-driven economies and what have you, quite vulnerable to climate change. On the other hand, you also have rapid urbanization and populations that are growing at rapid rates, etc. I think just pivoting from the talk about, you know, the financial sector, what to me that shows is that there is an opportunity in the real sector. So we talk about, the argument for building back better in, you know, developed economies post-COVID, etc. But there are pockets here where it's not even a question of building back better. You can actually leapfrog from, you know, not even having a conversation about transition because you're going green at the point of need at this point. And so I think focusing on the real sector and the opportunities that lie there. And as I mentioned, we have over 29 trillion of opportunities there between now and 2030. The idea of bringing in credit enhancements that would essentially mitigate some of the risks that Rick talked about, blended finance. This is where I think that DFIs can step in, offering, risk guarantees and enhancements and longer tenors that could, in fact, to the right investor, be the correct formula.
Absolutely right. Rick, a farewell word from you. What's your advice to the 3,000 people registered to this conference?
Well, hopefully the registered conference people are aware and interested, but I think do your homework and keep a really open mind, because that's the issue with finance, that where we've gone wrong is where people have narrowed their lens too much and haven't thought about these wider issues and bigger picture risks. I'd hope that the 3,000 who've registered are not in that category, but that's what I'd urge. Do the homework, keep an open mind, and then you really be part of the transition.
Rick, thank you for joining us today. I know you've got a hard stop. We've got a few minutes more. I want another couple of questions if Satoshi and Denise can stay. Look forward to the progress at SSGA in supporting this transition, bridging the gap between, as you say, where the capital is and where the solutions are. Thanks for joining us today.
Thank you.
Denise, so back to you. You've heard a lot of things about what they're doing and so on. I'm just curious in terms of the capital market world, and I'm really worried about the resilience impact, I should say the climate impacts that we're starting to experience in so many places around the world. Other steps we can take to bridge risk. And I guess I'm really going to what is at the heart, the changing role of development banks in the context of climate impacts. What are the next steps for you as an institution, IFC, and also for other development banks?
I think that the point is that we have the role that we play is multiple. So first and foremost, it's a demonstrative effect, and a good example of the way that we've done that is within the green bond market, right? So arguably one of the most successful capital market projects in recent times, but looking at how that began, right? So the fact that MDBs with the AAA rating that we have can come forth and actually try out these structures, as it were, and demonstrate to the market that these are viable instruments. So the idea of channeling, and you might know the statistic that for every dollar that IFC invests, $4 is mobilized in the private sector. So the ability to channel more private sector capital to the SDGs. I think we're at this this point now, this juncture, where we can humanize the financial risks that we're talking about. And so the audience that you have, your 3,000 registered audience, would run the gamut of finance professionals to academics, etc. And there's never been a time where we've had this much interest in these topical issues. And really this makes the role of the DFI, in my opinion, even more of a stronger position that we have to play in opening those opportunities, like I'd mentioned, bringing to the fore, blended finance, the credit enhancements, etc., and that demonstrative effect into the path less trodden into emerging markets in our case, for example.
I've got to ask you a bond question. Do you get higher subscription rates for your green versus vanilla at IFC?
Terrific question, and I would say the short answer is yes. So on our bond program, and for those who don't know, our annual funding program is around $17 billion. We are committed to being regular green bond issuers, in that we will continue to bring once a year at least a public benchmark and private placements. We are very responsive to those in multiple currencies. We certainly have seen, without a doubt, higher interest in our green bonds. We also, by the way, have a retail program, which is interesting because there are not very many institutions that offer retail green notes and social, which we both do. And I think that that opportunity to a wider investor base who would not necessarily naturally lean towards, a supranational as such, these products have certainly brought them to our arena.
That's very interesting to know. I mean, Satoshi, one of the curiosities of the green bond market is that it's actually flourished first in the uridashi market in Japan, with issuances by a variety of development banks, including EIB and World Bank Group. So you've got this big pool of domestic investors in Japan who really like this idea. I guess this is a broader question about what we do next with developed markets going forward. We have scope to tap retail investors. Whilst that's not huge pools of money, I actually think that's really important to give citizens like me a chance to do something with our capital when we have a little bit of money to be able to invest in the transition and green futures and to eventually vote with our money. So I'm sort of curious to see whether you see that happening. And I note that HSBC has launched a green deposit product in India recently, following on from what Yes Bank did a couple of years ago. And we see this bubbling up in different parts of the world. But perhaps the broader question is how we manage this risk issue going forward, because we need to ensure that the financial systems in our developed countries can continue to be sustainable with many facets, many issues. There's a management of the local economy, but there is also the getting ahead of the changes that are coming through, the transition. And we want to have capital moving in those sort of sectors, which is something you've been looking at scenario planning. I guess this is a bit just an open question to you. What are the other things you think that we need to take in your market? Do we need to bring in more risk bridging collaborations, let's say between JBIC and IFC, to be able to make it easier for investors in Japan to participate in other countries? Do we need to grow the preponderance of sustainable products with a strong supervisory oversight in Japan to ensure that citizens can do? Or is it actually all about tackling the corporate side and the industrial side going forward? I'm kind of asking for help here. What do you think?
Well, well, if I'm allowed to joke, actually Federal Reserve's dollar financing program helps very much because if that green bond is designated in dollar, and if the financial institution investing in those bonds, that would, as I said, to create a gap in asset and liability in terms of the currency mismatch. And so they need a dollar funding. So emergency dollar financing always helps to invest in equity bonds, designated in the dollar, or in a way. But that's a joke. I think without further risk mitigant measure, there's a very strong appetite actually among the Japanese investors to invest in the foreign currency designated bonds, because the interest rate in Japan is so low that they cannot make money out of it. So because as you said, there's actually very strong appetite for such products in Japan among the Japanese investors. So if that channel is open, I think we can reasonably expect that the Japanese investors will flooded into that market. So, but if someone somehow, not the US Fed, to assist financial institution to manage the currency risk and also the liquidity risks associated with dollar funding, I think, the investment in such global green bond market will significantly increase. I'm not sure it is feasible, but
a good line. Denise, take us out, the final word.
My final word for the audience would be rethinking our values. Let's green our values, I would say. It might sound trite, but I do think that we're in a system where we are in control of certain decisions that we've acted as though we had been out of our control. And so just being aware of that and rethinking our values, shared values, as Ikeda-san said.
Denise, Satoshi, thank you so much for joining me and us today. Thank you for joining this panel with Frank and Rick. It's been wonderful. There's so much to be done, but the truth is the elephants are moving. We know this. We can feel the thunder in the ground as the Japanese market starts getting excited about sustainable investments, as the European market starts getting excited about sustainable investments. And of course, we need to hear that noise across emerging markets where the capital has to flow in the future if we're to create a sustainable planet. For everyone listening in, thank you so much for your time. Join me again in 20 minutes when we're going to be talking to JP Morgan Indexes about a new climate index, and you're going to hear a brief word from JP Morgan CEO, Jamie Dimon. And then 2 more sessions after that. Thanks, Satoshi. Thanks, Denise. Talk to you again soon on this incredible journey we're all on to create a better world.
Thank you for having me.